Hi, Jill. Thank you.
And start the video.
How you doing?
Wonderful, Mr. Bush. How are you?
Hi, Burgess. Anna requested to be the first up on the agenda, if that's okay with you.
I yield to Anna.
Thank you.
I don't think it's too bad.
Yes, and Anna Parrish asked to be first because she's heading out in a car and she wants to be on camera for her report.
Okay. I'm calling the General Employees Retirement Plan Pension Board meeting for August 29th to order. Roll call,
Jonathan Griffith,
present.
Alan Bush,
Here.
Brett Dennis,
Here.
Tammy McCaskill. All right, we have a quorum.
Okay. Let's go ahead and take care of item number 2. Approval of minutes. Has everybody had a chance to review the minutes from the last meeting?
Yes, I'll make a motion.
All right, there's a motion. Is there a second?
Second.
Any further discussion? Seeing none, all in favor, say aye. Aye. Right, so there was a request to take item number 4 out of order. Is that correct, Miss?
Yes.
Okay. Miss Parrish, did we lose her?
She's not there. All right, well,
She might be in the parking garage. And sometimes you lose signal in there.
Well, let's go ahead and take 3A until we get her back. Dates for training.
this is something that Burgess, Dwayne, Madron, and who you don't know for the other pension boards, but and Anna Parrish are going to put on a training event at our next meeting. They want to do it at lunchtime, so between the end of the police meeting, which is until 11:30 at the latest. So training would start around 11:30. There'd be a lunch. They would train you on sunshine laws and just educate you some more. It's so you don't have to go to a conference and to help fill the requirement that board members be educated yearly or annually. It's not a requirement in our pension, but it is not expected, but encouraged, I guess is the word.
I think it sounds great.
So there would be like 11:30 until about 1 o'clock because the next pension happens at 1:30. So it'd be an hour and a half with lunch and training
When-
for all the board members at the next pension board meeting, November 28th.
Perfect. Yep.
But I'll send out all kinds of information about that.
Okay, you don't need any action on that, do you?
No,
Okay. I do not see Miss Parrish.
she,
What was that? 11 to what now?
11:30 to 1
11:30 to 1.
on the 28th of
Yeah.
November. Well, maybe we should start with Burgess then.
Okay,
Thank you. I would suggest that you notice the meeting,
Okay,
the training, education, just to be, yeah. I mean, you notice the regular meetings, but I mean, it is a public meeting.
Yeah.
So,
Good call.
okay, great. I guess I'll start. Let's start with the investment policy, Jill.
Yeah.
Please. If you would, please go to page 7. As you know, the governor signed House Bill 3. This affects us because the governor does not want pension plans to focus on social governance or environmental issues as a primary determinant of the investments. The so-called pecuniary factors, meaning investment returns, expectations, performance, is first and foremost. So the language that your attorneys put together, I incorporated under Section 8 under Florida statutes, and it begins under definition A and B and so forth onto page 8. That's something you have to have in the policy. It's not negotiable. It's there. If you have any questions, perhaps Anna can answer them in more detail. She did speak on this at the last meeting. Any questions about Section 8? The new
No, this
language?
is about ESG, right?
Yeah, it's essentially the governor's wishes, and he signed the bill that ESG factors be secondary or tertiary in the investment process. First and foremost is the investment returns and expenses.
So what does that acronym stand for?
Environmental, social,
And governance.
governance.
Yeah.
That you.
ESG has been around since 2004 when Kofi Allen, the Secretary of the United Nations, introduced it. This is not a new concept. Several states, Texas being another one I can think of, have put in place this type of language requiring that pension systems not focus on ESG when it comes to investing.
Okay, so the recommendation is to adopt the revised investment policy. Is that correct?
Yes, and if I may, I did another area of revisions. If you could bear with me and just go on to page 2.
Okay.
This is a good time to revisit the asset allocation model. And while I'm going through this, Jill, do you have the program analysis, those little graphs I put together?
Yes.
That'll come up in just a second. Okay, well, you can leave it right here for now. So this goes back 10 years and looks at in blue the current strategy, how it's performed, and the 70-30 index, that blended index that everybody's heard of, and then the proposed is in yellow, so that this shows is over the last 10 years what we're proposing is really better. Go to the next slide. The next slide looks at the risk return profile. This is the last 10 years as well, and the yellow dot being higher and a little bit to the right. Overall, it's a more favorable return risk profile than the current program. Next one. Is there a next slide? This is a 3-year, so we have all of these different periods essentially confirm a lower risk than the 70-30 and a higher return profile with the yellow. Now, if you jump back to the page 2, please, Jill. What has happened here, this table, I'll tell you what's changed. First of all, we've taken the REIT out completely. There was a 5% allocation to the REIT, so it's disappeared here. We've raised the S&P 500 target from 25% to 40%. So we've shifted within the 70% equity allocation. We've shifted 5 away from REITs. We've shifted 3 away from convertible bonds, from 8 down to 5. We've moved international down from 15 to 8. And so when you do these things, you raise 15%. And so we're moving that 15% up into large cap. Now here's why. The large cap, the S&P 500, is a very good, very solid low cost way to get exposure to US stocks. And we believe that moving a little bit off of infrastructure, a little bit off of convertible bonds, moving the international down and pushing that difference up into the 500 makes sense. Infrastructure and convertibles are more defensive than we need to be at this point, because I think a lot of the heavy weather is behind us now that the Fed has raised rates. That shock is now behind us. International globalization is uncoupling. It's been uncoupling now for the last couple of years. We have had a nice run in international since October, but macro factors look less and less attractive. One, China trade with the U.S. is on a rapid decline, and also with Europe. And China, Russia is a new sphere of the world economy that really is going to become insulated from, much of it will be insulated from the West. So that's why we decided to shift the international exposure down from 15 to 8. If you want exposure to international stocks, you can get it. International companies, you can get plenty of it from the S&P 500. These companies all are multinationals, whether it's John Deere or Caterpillar or Boeing, food companies, Coca-Cola, they all have operations around the world. That's Anna calling me. Hang on a second.
Patch me in.
Hey, Anna.
Hey, Jill.
Yeah, I'll tell you what.
Where do
You
we
need
see
to
the
Zoom.
existing allocations?
I'll have I'm actually on station right now. I'm gonna have Jill will just send that to you right now. Okay. Jill,
Yes.
that was it. She asked if you could resend the hyperlink information to her so she can jump on the call.
Okay.
So essentially that's it. We're shifting away from where we think there's less opportunity within that 15% shift over back into the S&P 500, where I think you are a much safer place.
And what was the
And-
S&P before?
25%.
Was it? Okay.
You know, we liked the convertible bonds for a number of years, but now that rates are back to where they were 20 years ago, believe it or not, the convertible bonds don't really offer as much bang for the buck. You're better off just pushing that difference over into the S&P 500. The infrastructure is fine, but we've cut it back a little bit. It's very conservative. In fact, 43% of the index now is in utility. So we don't need that much. We're trying to lessen the exposure there, and we talked about international. I'm trying to get this program to grow a little bit faster, and that's why we wanted to push more of those equities up into the 500 index.
Burgess, there was a question on the targets.
Yes.
What they previously were.
Yeah, I'll give them to you right now. The 500 was 25, and now it's 40. The 400 is unchanged at 6. The 2000, which is small cap, remains at 6. The convertibles were at 8. Now they're at 5. The international, that's the MSCI EFI, was at 15. Now it's at 8. We reduced the private real estate down from 7 to 5. Bloomberg aggregate bond, we've increased from 18 to 20. So we pulled 2% out of the private real estate and pushed it into the
Infrastructure.
Infrastructure. How much was infrastructure before? I didn't get that one.
Infrastructure before was let's see. It's on. It looks like it's on. Let's see. Looks like infrastructure. Just double check this. Hold on. Infrastructure is unchanged.
Okay.
It's, I guess I talked over myself. It already was at 5. In other places where it was at 8, we cut it back to 5. So it's still at 5%. Any other questions?
I don't have any.
No.
Mr. Bush?
Okay.
No?
No.
Okay.
So with that, I would urge you or someone to make a motion to adopt the investment policy. That'll get the House Bill 3 language in place, which is required. And then the new model, allocation model will also go into effect in 31 days.
That said, is there a motion to accept the revised investment policy statement?
I'll make a motion that we accept it. Second.
All right, there's a motion and a second. Any further discussion? Seeing none, all in favor, say aye.
Aye.
All right. Thank you. If Anna wants to jump in again, I'm happy to step back here.
Do we have Anna?
Anna hasn't logged in quite yet.
Okay.
Okay. All right. Well, let me just jump on my report and I'll speed through that. Page 1. So one of the unintended consequences of the Fed raising rates 11 times is now we have 8% mortgage rates. And so,
Burgess,
yes,
I believe Anna just jumped on.
okay. Well, I'm happy to yield to Anna. Go
Hi,
ahead, Anna.
everybody. I'm so sorry. I couldn't find the Zoom information. It disappeared somewhere in my email, and I apologize for interrupting Burgess. I just wanted to quickly address the board. I'm in the car, so I apologize that I do not have my camera on, but I just wanted to quickly give a report, which mostly today is focused on the new investment policy statement that Burgess prepared in combination with our office. I assume, just as the other 2 boards did, all questions will be answered and you can hopefully adopt those so that we will be in compliance with the requirements set forth in House Bill 3. I'm sure Burgess, if he hasn't already, will let you know that there are some new reporting requirements that will be put in place starting in December. We don't have that information yet. We're waiting for guidance from the state on that. And as soon as we get that information, we'll be in discussion with Burgess's office to make sure that you all are doing everything that you need to do to be in compliance with those state requirements. And that, once that's taken care of, we will be good to go. But if there are any questions, I'm happy to answer, but that is my quick report for today.
Any questions from the board?
No. My only statement, if I could, the ESG piece, it's just that we wouldn't give preference to corporations who were showing that they were more woke. Is that correct?
Basically, the investment managers, their number one decision-making factor needs to be pecuniary gain. So they just need to focus on making the most money, with the least amount of risk, which I have a very strong feeling all of them are already doing. I don't think it's going to affect your portfolio strategy in any way, shape, or form. But because of this new law that has been signed, those factors cannot be the main focus for decision making. There can be considered, but overall, pecuniary gain is the number one factor.
All right. Thank you.
Thank you. I apologize again for interrupting, Burgess.
It's not a problem. Thank you, Ms. Parrish.
Thank you.
So, Ms. Kaiser, should we flip back to Burgess's report?
Yes.
Okay.
All right, thank you. It's a small world. Anna went to Stetson Law School with my daughter, and they graduated the same class, which is amazing. What a small world it is. Back to page 1. So one of the unintended consequences of the Fed's aggressive policy in raising rates to curb inflation is that people are unwilling to sell their homes if they have to basically deal with having to pay 2 or 3 times more for a new mortgage. So they just stay where they are. So there's a shortage of homes in many metro areas around the country, and that's keeping the price of housing extremely high, in spite of the fact that incomes are really not keeping up with those high prices. So that's one reason why we think the Fed is likely to begin lowering rates sometime next year. We suspect a pause will happen before the end of this year, maybe one more increase. So that's something I wanted to point out. The other thing I wanted to point out is that interest rates, bond yields, if you just look at the 10-year, we haven't seen bond yields this high in 20 years. And that's a very positive aspect for pension plans. And I should mention to you that the private sector pension world, they've already started pausing on lowering rates, expected returns, and are talking about raising expected returns. Now, you've been under pressure from your actuary for a number of years to lower your expected return. I mean, FRS is at 6.7. But that, my sense is that pressure has ended. And that's really good for the city. As you lower these expected returns, it's going to put more pressure on the city to have to contribute more money. Any questions about that?
No.
Okay. Jill, let's go to the summary page, please. It's a couple in from here. Okay, that's good. Let's go one up. One up from there. You go. For the quarter, the program earned 620,000 or 3.2%. A little bit behind the target, but not much. You've got fees and so forth associated with that, with the actual management versus the indexes in the model, which are cost free. Large cap growth was the best performer, actively managed at Voya at 13, followed by the index product, which it's supposed to beat, and it did for the quarter. As you know, we split some of the Voya money off to acquire the Fidelity piece. That was done a meeting or two back. The Fidelity product is still a little bit ahead on a fiscal year-to-date basis. Mid-cap was in the next position, followed by convertible bonds. Fiscal year-to-date, that's October 1 through June 30. The plan had earned 2.2 million or 12.3%. As I wrote this report in August, results were closer to 15% fiscal year-to-date. 3-year average, 5. Of course, remember 5.5% or 5 net. We were dealing with the last year, which was a really tough year for everybody, and that's captured in that 3-year period. It's also captured in the 5-year. In May, 200,000 was raised from Voya large cap growth to cover expenses. And I should mention that the last bullet, we suspended in June the dividend reinvestment program at American Core Realty. You know, we do like real estate long term, but the headwinds of the office problem, 20% of the portfolio is in office properties. COVID changed everything, as you well know. People don't want to go to the office anymore. In fact, 95% of government employees, federal, are still working from home.
Wow.
We just concluded an SEC audit. They were in our office remotely. The audit started 5 months ago, and I'm happy to report that we came through very well. Very pleased with the team and how they worked with the SEC. But the meetings that we had with the SEC were all remote. All 5 of their analysts, research people were all working from remote locations. And this is the way it is today. So back to American, we decided to forego investing the 3.5% per year income approximately you're getting off those properties. That money is just simply going to the bank and being used for regular expenses that the city has for payments, retirement benefits. And then when the market improves, things settle down, we'll click that reinvestment program back. We've done this with all of our clients. Now, there is a redemption queue if you want to redeem principal, but the redemption queue is very cumbersome, and I'll tell you why. We started doing this with some clients about 2 quarters back. The amount of money that's being redeemed is very small because there's a long queue to get principal back. In contrast, the income from the properties themselves is available right away. The other challenge, once you redeem principal capital, at some later date, if you want to then decide you want to pivot back in, the same thing happens. You get into a long line again to get back in. So it's just not an efficient way to do it. In fact, Ash Williams, you may know that name because he was the CIO for the FRS for a number of years. He's a friend of mine. We talked about this strategy of pivoting with the principal side of it. He and I both agreed it's not an efficient way to handle private real estate. Next page. Page 5. We talked about Voya. Their results for the quarter we're ahead, which is good. And if you look at the results here, they're pretty impressive. More recently, Fidelity Large Cap Growth Index was ahead, pretty much in line as it should be for the quarter. Large Cap Value was in line for the quarter and ahead for the year. Mm-hmm. Mid cap, a little bit behind, and I talk to these guys all the time, and it's just stock selection. They're a little bit behind on a 10-year basis, but not too far behind. Active managers, by and large, have missed their benchmarks over the last 10 years. Cohen and Steers, this is infrastructure we talked about earlier, which we're leaving at 5%. They're doing what they're supposed to be doing. They're adding a little bit to the bench and ranking in the top quartile. But 43% of their portfolio is in utilities. So it's a pretty conservative program. We did scale back the convertibles. They did what they were supposed to do. They added significant performance to bonds over the last 5 years, and that's because of the equity optionality that's built into convertible bonds. Euro Pacific is recovering. The delta or difference between their results and the index is still apparent. A little bit of underperformance, but that has really narrowed. And if you look at the longer term results, they're more in line with the index. The bonds look pretty boring here because of the history. This is all historical, but the bonds are really set up very nicely for the future. As these issues mature and they're redeployed at higher yields, higher coupons, I would not be surprised if 5 years from now, if you look back, you're going to see bond returns in the 5 to 8% range. All right, I'll stop there. Are there any questions about the report?
So Burgess, we're kind of, at least I am, a little pressed for time with the hurricane, but I'm curious on page 6. you've got this check down here. It says that we did not hit our strategic model over the 3-year rolling period. 5.5 versus 6%. Do you take that into consideration with the revised investment policy that we just approved?
I do, absolutely. The short answer is yes, and the other part of the answer is we had several of the actively managed pieces did not achieve their underlying benchmarks. We talked about Euro Pacific, we talked about mid cap value, we talked about Voya large cap growth, and so when those three,
What size are her shoes?
that's it.
Oh, okay. These are a 9. They're like.
That's Anna.
Thanks, Jill.
Thank you very much. So really, there are two answers. The short answer is the changes we made address it. And the other part of the answer is that the 3 of those active managers did not achieve their benchmarks. And that's why there was a trailing performance for 3. But it's not too far off, but it's enough to discuss.
So the biggest shift is really in the REIT to the S&P 500.
Of the 15%, that was the biggest piece. And the second big piece was international, because we pulled that back by 7.
But when you talk about principal in that REIT, I know when we talked about that agreement, there was, I think every quarter, was it every quarter you could request some of your principal?
Yes.
So is that something that you're going to be monitoring, or are you saying we only have a 5%, so leave it alone and we're going to watch it for a while and see if we need to make a reallocation to it or abandon it completely? What's your take on that?
Well, I like real estate long-term. I like the private stuff long-term. I say, let's continue with the current redemption. We're not going to take any of the, we're not going to reinvest any of the income for the time being. We're going to take that back. And we're going to let the allocation, let it stay around 5%. And then at some point in the future, when the environment changes and the real estate market is healthier, prospects are healthier, we'll look at making some changes there, perhaps adding to it. But right now, we don't see any practical reason to redeem principal from the private real estate. We'll watch it.
Does anybody else have anything? I don't think there's any more questions. Do you want to continue with the report? Is there anything else that you want to bring to our attention?
Not really. I think I've covered it all. I'm pretty excited about the new changes that will go into effect in 31 days. And next year, I think we're going to see some more favorable interest rate environment begin to open up. So I think it's a long-term strategy. I think you're well positioned for it. That's all I have for today.
Okay. Thank you.
Thank you.
Do you want to vote and accept this?
Yeah.
Make a motion that we accept the report as given. Make a motion.
All right. We have a motion and a second. Is there any further discussion? Seeing none, all in favor say aye.
Aye.
Aye. Okay. Ms. Kaiser,
Okay.
quarterly expenditures.
Quarterly expenditures. Getting down to the bottom. So we're really looking at April, May, and June. Nothing unusual in that time period. A couple of contribution refunds. But when compared to budget, we're under budget still. So I don't think there'll be an issue at the end of the year either, the fiscal year. But
Jill, do you want to go ahead and talk about the revised budget while we're on this?
sure.
Okay.
The next issue we were going to talk about is the budget revision. The commission passed a budget for this coming fiscal year 24, and it included a position called pension and benefits administrator. If you don't, you find it in your packet, I have some more of these.
Let's see.
Okay. And the idea is that the position would be again paid for by the various pensions, the 3 pensions at a percentage rate, with the city picking up 25% of the cost of this position. Currently, the pensions each contribute $7,000. You can see what the increase is, what the proposed contribution rate is, the estimated wages. If you notice, those benefits are extremely high, but that is what the city, that's the highest portion of the health plan
Yeah.
at the highest rate.
Sure.
That doesn't mean that's necessarily what's going to be, but that's for budgeting purposes. And the position has not been yet slotted into our step and grade plan. That's, but this is our best estimate at this point. The position would report to HR, but it would have a very intense accounting background because that's what's needed for this, as well as HR in the sense that it would be a benefits administrator. So they would help with the benefits, the health plan, updating renewals for both retirees and current employees.
So Jill, that 25% cost to the city, you've got general police and fire. Is that just going to come straight out of general fund?
No. Yes, the city portion of the 25%, yes, just like my salary comes out of the general fund.
What about the gases portion?
Well, that's a good question.
About the what?
Gas authorities portion.
Well, see, the gas authority doesn't get charged for Virginia's salary,
Mhm.
and yet Virginia does their benefits administration.
We'll have an offline conversation. Okay. So are you looking for a recommendation?
I'm looking for a motion to accept that the general pension will contribute instead of 7,000, the 21, because we had passed a budget in June saying they were going to contribute 7,000 in fiscal year 24, but what it will be if they agree is 21,450. So the general pension would contribute, but they make up the bulk of the retirees. They make up the bulk of the current employees. So that's why they have to contribute a higher percentage. And my position, well, this position will be looking for a person for it until January, hope to hire somebody by January, because in January is when I start doing all the work for the Division of Retirement to do their annual reports and send in the annual reports, and they would be here for that 2 months.
And
when
what
I'm
is
doing all
your
these.
projected last day with the city?
My projected last day is October 26th of next fiscal year. So that gives them a time when they're learning all that has to be done in January for the pension meetings, for the pension and the state of Florida. Then come the valuation reports in from the actuary in March, and they'd be there for those meetings. And, and by June, they should be planning the meetings and being able to host the meetings themselves, I'm hoping. So it gives me time with that new pension person to train them. And then the new person from my position, as far as finance, would start in July. So we're splitting my position into 2 because it's necessary.
Right. But your last day is?
October 2024.
26.
Yeah. So we have a year to get, but I'm
Wise,
just
though.
succession planning,
Yeah.
and it has to be done early enough.
So the request is to adopt a revised budget, which includes a dedicated pension and benefits administrator,
Yes,
of which a portion would be paid for out of the general fund pension and the general fund.
the general fund itself, right?
And the other boards have already approved.
Yes. They had discussion and
Yeah, I bet.
but it just, it makes sense to long-term.
Mhm.
And it would benefit the pensions to do it now and not wait until I'm not here to train somebody.
I'll entertain a motion or any questions? Mr. Bush? You got that look on your face.
Well, yeah, I was a little puzzled about what we just went over, but go ahead, gonna make a motion to accept it. I'm not gonna sit here and study this thing till I fully understand it.
Well, you understand that when I was hired as a financial services person,
Right.
as full-time. But and we had a part-time person doing pensions, as well as HR cooperating and helping with some of the pension work. So it was more than a half-time position when I was hired. It then devolved into me as things shifted around, but I'm suggesting we go back into a more full-time position again. Because it will help educate, especially the general fund employees. Really, I want to see the new position more actively educating and being involved in going out to the departments, explaining the pension to people, seeing if that will help with retainage of employees, because they really don't know what they're missing by leaving before they hit their 7 years, and try and get at least 7 years out of people. It's really worth it to them in the long run. So
I'll make a motion that we approve.
Second,
All right, there's a motion and a second. So Jill, the decision as to when to bring that position on, that'll be determined when the budget is actually adopted, correct?
yes,
Okay,
the theory of it is we have till January to get somebody up and in that position. That gives the city 3 months to advertise and look for a
what do we do if
person.
we can't find somebody?
Well, that's a good question. Well, I think we'll, work until we find somebody. If it's
Okay.
not January, it'll be,
All right,
Ask Ms. Thomas how that works.
careful now. You're poking a bear. All right, any further discussion? Seeing none, all in favor, say aye.
Aye.
Did
Is
you have
that
a
Ms.
question?
Thomas
for me,
voting?
Mr.
Yep.
Griffith?
I don't think you get a vote, but we'll put it down anyways.
Okay, I vote to adjourn, so.
Yeah.
Right, so real quick, Jill, can we go over the meeting dates? Do you need any action on that or? February 27th, June 4th, August 27th, and December 3rd.
yes, that's in 2024. So don't think it's this year. It's next 2024.
Be kind of
Um,
hard to be this year since
yeah,
most of
well,
it would already pass.
yes.
So,
These were approved by Burgess and the attorney. Just be sure it's all on.
all other
Yeah.
boards approved, same dates?
They did.
Okay, is there a motion?
Motion to approve.
Is there a second?
second.
No further discussion. All in favor, say aye.
Aye.
Aye. Okay. Public comments? Is there any further business, Ms. Kaiser?
No,
How
Okay,
about Is the
Sorry.
education, did you talk about the education? We covered
Yes,
that.
yeah.
Okay, just want to make sure. Thank you.
yep, we're all on board.
Very good.
Okay, is there a motion to adjourn?
Motion to adjourn.
All right.
Hello?
So Burgess, tell me a little bit more, why the big allocation to S&P 500? Is that because interest rates are going to stay higher a little bit longer and you're going to see people going to stocks? Because that's how those companies are going to raise money. What's the logic here?
Well, the S&P 500, years ago was back in the 70s was dominated by the oil companies. Then just 15 years ago, it was dominated by drug companies like Merck. But now it's dominated by companies like Apple and Tesla and Google. It's changed. It's a dynamic index, and it represents where the economy is going and where the capital is going. And it's been a very challenging benchmark for all of these active managers to beat. So that's why we like it. And that's where the money's going. I think that's the future. And
Okay.
that's the short answer. And I just wanted to make sure that you follow me with this. Right now, you have large cap growth with Voya and the large cap growth index, and you have large cap value with an active manager. So when we do this rebalancing, some of that large cap may simply be folded into the S&P 500 index. So, for example, we may add a position, a new product, if you will, which would be the index itself, which has no fees associated with it. It's consistent with investment policy because the policy has a large cap target allocation, which is represented by the S&P 500. So you don't have any objection to that. That's something we'll probably be doing.
I just assumed we were in an index. I didn't. When you had the S&P 500 allocation, I just thought it was an index tracking the S&P 500. Is that not correct?
Well, not exactly. What we have is we have a large cap value piece and large cap growth piece. And when you collapse them together, you get an S&P 500 expectation.
Okay.
All the S&P 500 is large cap growth and value stocks in the country blended together roughly 50-50. So we've done that over the years and used the 500 as a benchmark out there, that an objective. So what we've done with a lot of clients is we'll take some of that large cap mandate and simply have a portion of it in the S&P 500 index, actually invest in the index. The adopted policy does not prevent us from doing that.
Creative. Okay.
It reduces your fees.
Yeah,
And
you too.
it's a good thing.
All right. Well, we're gonna run.
So,
We
all right.
got a storm to get ready for.
Well, I'm in Savannah right now, and it's coming straight here.
Yeah, it might break up a little bit before it parks on top of y'all for a while. So
I hope
just get
so.
your umbrella out.
Thank you.
All right. See you.
See y'all. Bye-bye.